Welcome to This Week in Intelligent Investing, where we examine timely and timeless investment topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Chris Bloomstrand, Phil Ordway, Elliot Turner, and other thought-leading investors. Brought to you by MOI Global. And now, here is your host, John Mihaljevic.
A very warm welcome to everyone to another episode of This Week in Intelligent Investing. We have a great episode ahead featuring a special guest today in Larry Cunningham. I'm sure everyone knows Larry Cunningham, a corporate director, governance expert, professor. Larry and I recently had the pleasure of discussing his book, Dear Shareholder. That conversation is available on the MOI Global website. And Phil Ordway is here as well, who will kind of steer the conversation with Larry, as Phil has done a ton of work in the area of corporate governance and capital allocation as well. And just a note, Chris Bloomstrand and Elliot Turner are not here this week. They'll join us again next week. So Phil, I don't know if you want to introduce Larry a little bit more, although I'm sure he doesn't need any introduction, so maybe you want to kick it off, but I'll turn it to you. Feel free to take it away.
Sure. Yeah. Thanks, John. I appreciate it. I'll say a few words and then I want to dive right into the conversation with Larry. So if anyone's not familiar, I assume most of you are, but Larry's career is really fascinating and something that I've come to appreciate even more in recent years. So he started his career in academia after a career practicing law and has become one of the countries in the world's foremost experts on corporate governance. And we'll dive into the various angles of that. But for anyone who's missed the last few episodes, I've been leading kind of a side conversation about a topic that's been increasingly interesting to me in recent years. And that's kind of this notion of the interplay of corporate governance and capital allocation and investor relations and how they all pull together. And this is something Larry and I have talked a lot about and something where he spent 10, 20, 30 years really enmeshing himself in that world and becoming one of the world's foremost experts and directly be interacting with, I think, two of the single best examples you could possibly ask for, namely Warren Buffett at Berkshire Hathaway and Mark Leonard at Constellation Software. So we'll get into quite a bit of that. If for anyone who's not familiar, would highly encourage you to check out all of Larry's work. Just Google it. It's all out there. I think we're up to 20 books now, Larry, something like that. Best known probably for the essays of Warren Buffett, where he, with Warren's explicit help and blessing, took the essays that he's written over 56 or 7 years now and collated those all by topic. Has written some other great books, particularly about the value of culture, the value of communication, something we talked about in the investor relations area. And lately, one of the topics that, his latest book, which will be coming out, I believe, later in October, is about quality shareholders. And the full title is Quality Shareholders, How the Best Managers Attract and Keep Them. He's also written a paper that I think came out earlier this year, but certainly not too long ago. The title of that is The Case for Empowering Quality Shareholders. So that's something I want to dive right into. And Larry, maybe you'd be better off certainly than I would sort of explaining what you mean by quality shareholders and then what your ideas entail for empowering them from there.
Thanks, Phil, and thanks, John, for having me back on the program. By quality shareholders, I mean that small cohort of investors who have relatively long investment horizons and relatively high investment concentrations. And I just have a little 2x2 matrix in the materials where I relate horizon and concentration, and you'll recognize the familiar categories. Indexers tend to have long time horizons, but virtually no concentration. Transients, short-term holders, may hold in large stakes, but never for long. And both of them add something valuable to the ecosystem. Indexers enable ordinary investors to get the market return at virtually no cost or risk. Transients add liquidity and help facilitate deep capital markets. So there's nothing against them, but the quality cohort, the group that both concentrates and holds for long periods, adds something very special that neither of them do, which is typically an understanding, a familiarity, and a resource for corporations, as well as a stabilizing force in capital markets. So the idea of the research is to try to identify who those quality shareholders are, which companies tend to attract them, and why.
And would you say it's safe to believe that it's a mutually beneficial, symbiotic kind of relationship? I mean, this is something that really hit me over the head in the past few years, which is that companies are very explicit and very direct in targeting their lending group, whether that's banks, bondholders, et cetera. They want to really make sure that their lenders understand what the company is up to, understand what their securities and protections are. It's a very direct, very intentional relationship. Whereas on the equity side, it's almost completely ignored. And I think, one, I'd like to hear you opine as to why so many companies completely ignore who owns their stock, and likewise, why so many companies actually explicitly encourage their stock to be turned over more. I mean, we've seen these stock splits come back in the news inexplicably in the past few weeks. So I'd love to hear your take on that. And then secondarily, what can both sides get from, that relationship that's beneficial?
Yeah, I think you're right that corporate managers tend to be much more consciously solicitous of their lenders with active relationships and cultivation and so on, and certainly compared to the equity. And it may simply be a perception that it's a smaller group. It's easier to reach out. It's easier to just stay in touch, and things are contractual. So the covenants, the representations, the entire arrangement is fairly spelled out, and so it may just seem easier. Equity is dispersed, vast, changeable, no contracts really to speak of at all. So that's a sort of benign explanation. Another might be that managers, many of them anyway, may be very happy if they simply have a rising stock price, whatever the underlying business value, whatever the relation between price and value. And so they may not care if they have a particular sort of stockholder, so long as the stockholders as a group help to drive the price up. And certainly indexers will tend to do that simply by being in the index. Demand is generated for stock. And transients are sort of known for chasing prices up. So quality shareholders will tend not to be so fixated on price, certainly in the abstract or as something that's simply higher and higher and higher, but rather some orientation towards a rational relationship between price and underlying business value. So for managers who just want the stock price to be high, they may not care too much about whether they have many quality shareholders. So that's a more cynical explanation. But why should they care? What's in it for companies to have a higher density of quality shareholders? Well, the first point I'd make is that this is going to be a group that tends to be more careful, more thoughtful, more engaged with a company, more willing to understand strategy, more willing to think over multiple periods rather than short periods of time. And that kind of group does a lot of things for a company. First, it gives a team, a management team, a longer runway to execute on strategy without fixating on the current quarter or even the current year, but to give managers a little bit of a benefit of the doubt, a little bit of a runway to execute on strategy. The second thing it does, it provides a resource in the ultimate case to appoint members of this cohort to the board of directors, or simply to have available as a consultant, usually a cheaper or free consultant on how strategy is being executed, whether a particular capital allocation decision is optimal, and so on. And look, ultimately, when companies face difficult cross intersections, whether it's a major proxy battle, an item, a controversial item on the shareholder meeting agenda, whether it's on climate change or gender diversity or what have you, it helps to have informed, engaged, patient stockholders to turn to make a case about what management's views are. So there are lots of, I think, very, very important and powerful reasons why it pays for a company and its managers to have a high density of long-term concentrated shareholders. You're going to have some indexers, you're going to have lots of transients, but there are lots of benefits for companies to to cultivating this cohort too, and many, a lot of companies do. It's not as if it's a complete matter of indifference, but it is surprising. You're right, Phil, about how many more resources the investor relations function allocates to cultivating the lenders as opposed to the equity. When I think it can be often more important to have a reliable, stable shareholder base.
Right. And to the extent they allocate any resources to the equity side, it seems to be all in the wrong places, either cultivating the sell side or encouraging sort of the transient owners that are just going to come in and out and come and go. But then, at least in my experience, when you really drill down on that, whether it's with the investor relations function directly or with the CFO or the CEO or even the board, they all voice frustration with how much time they waste on that function. I mean, I'll never forget meeting Mark Donegan right after Berkshire bought Precision Castparts, and he said he used to spend 20% of his time, or one day out of every 5, just sort of flying around, meeting with, talking to, calling, the sell side in the quote unquote Wall Street community. And what a relief and what an unburdening it was for him to be rid of that. So it's just really odd and really frustrating to me that more companies don't see this as being in their best interest. So I wonder what you think about the best way to encourage this sort of change, because if you and I and everyone all agrees that this is good for the companies, good for the shareholders, good for capitalism and the corporate world at large, why is it getting so little traction? And the only answer I've come up to is that we need to continue to speak more to interest rather than reason. So you've written recently about keeping the wolves away, which I think was your phrasing for the way Buffett has designed this function at Berkshire, in the sense that he never wants to be subject to attack by a hostile takeover, an activist, some sort of proxy campaign that he thinks is contrary to the long-term interests of the company. So is that the best way to go about this, is in interacting with companies to say, look, that if you don't fix this, someone will come along and fix it for you, and really try to put the fear in them that way?
That's certainly a good illustration, and I like your premise that appealing to rational self-interest is usually the most persuasive strategy to get people to change their behavior. And yes, I think pointing out to managers the advantages, some of them that I just referred to, about having a brain trust, having a runway for strategic execution, and your point on the wolves away. I mean, one of the empirical points that I try to do in the book, I try to make the book as empirical as possible. I mean, I try to investigate which particular investors have these qualities, which companies tend to attract them, and why. And then I look at the performance of the investors and the investees. And one of the things I drilled into was, to what extent can the existence of a high density of quality shareholders influence the outcome of activist campaigns? And I identified a number of examples, and some of them have been pretty prominent, where an activist approached a target with a whole list of problems that needed fixing, and the exact business plan and business case. And that one of the things that quite a few of these companies turned around and did is, so, well, let me call my quality shareholders. Let me call my 3% 12-year holders and see what they think. And in numerous cases, that cohort sided with management, and as a group, in effect, was able to resist the activist overture. If those companies didn't have that group that would listen and understand, they'd have been turned out. And and you see activist campaigns. Some activist campaigns are dead on, and there's a troubled management that needs a boost. But there are other campaigns where it's sort of a head scratcher, where management lost, but it looked like they had the better case. So appealing to self-interest. I mean, Warren's phrase about keeping the wolves away. I think that the long story at Berkshire is precisely that the reason that Berkshire was able, no activist investor has ever made a run at, or even close to at Berkshire. One of the reasons is Warren's halo and his ownership, but a huge reason is virtually all the stockholders are quality stockholders, and they wouldn't defer to an activist. But a lot of companies don't have that kind of support, and it can be decisive. It's been decisive in a few cases. So I think you're right, Phil, and I think that The other thing they can do, the managers, how do you, Radigan is right. Many CEOs spend a day a week, just kind of soothing transients and indexers, and it is a treadmill, and it wastes a lot of time. And one thing you'll hear the CEOs say is that in so many cases they go back quarterly to the same large funds, and none of the analysts are the same. The people who are following the company change all the time. Or in the case of indexers, there isn't even anybody really following. So it's extremely frustrating. They've got to just try to, it's hard to do, but it's trying to avoid the behaviors that tend to really attract those transients. I think the biggest one that we're able to document are quarterly forecasts, quarterly guidance, and then the quarterly calls. It's a huge time suck, and it tends to focus the whole team on short-term quarterly results, and that attracts the quarterly focused holders. So giving up that kind of conduct would help, and we've got evidence that show, and my research and research of many others shows that companies that suspend quarterly guidance or quarterly calls do tend to increase the average holding period of their shareholder base. So, another example I would list is avoiding stock splits. This is in the news recently because Apple and Tesla have both signaled an intention to split their stock because it's they're both at runaway highs. And I don't want to opine on the particulars there, but there is clear evidence that the companies that have very high stock prices, many of them with the 4-digit stock prices, have a far higher density of quality shareholders, that this group with long-term conviction. And it's for obvious reasons. One of the reasons Apple and Tesla want to split the stock is they want to have more shareholders buy it. And that's also going to mean more shareholders selling it. And so, Berkshire is obviously the extreme example with a 6-figure stock price, but so none of those companies with the 4 figures have a history or a pattern of stock splitting. And so there are things that managers can do. We're going to lay them all out in the book and really try to provide a bit of a roadmap for companies who are interested in shifting their shareholder base a bit to what strategies they might adopt.
So one other thing that I've been working on, you and I talked about this as well. I did sort of a poor man's study of the S&P 500 just to find companies that had some sort of structural element to address this, whether it was financial capital allocation or investor relations in the governance sense of it. And the short answer is that very few, bordering on statistically 0 companies, have a structural component of that to their board of directors. So I wonder what you think about, making that change. So I don't suggest that it maybe should be required, and I'm very wary of, less is more. You don't want to make more bureaucracy just for its own sake. But do you think it would be effective to make an explicit focus on that at the board level, and whether you call it a finance and capital committee or a capital allocation committee or an investor relations committee or something like that? Because the default answer is always that, that's a responsibility of the governance committee, or, that's a responsibility of some other committee. And it just seems to fall through the cracks too often. So do you think that's overkill, or do you think that would be helpful?
I think you make an excellent point, Phil, and I agree entirely. I think capital allocation is a practice or philosophy that quality shareholders understand well and care a great deal about. And managers who get that and who respond by explaining their philosophy of capital allocation, their approach to allocating each corporate dollar, will attract quality shareholders in higher density. That's an important theme that connects the two communities. And therefore, I think you're right that companies that want to signal a conviction that capital allocation is important, that how each dollar is allocated is really their job, their responsibility to think about it, explain it, and measure the effectiveness of each deployment is a terrific way to attract quality shareholders. And if it was a formal expression, so a board committee that's the capital allocation committee, or, as you say, the finance committee, the name isn't as important, but that there's a group that actively develops the company's thoughts on how do we think about reinvesting in existing businesses? What's our internal rate of return on acquisitions? What's our policy? At what point do we make buybacks? What's our approach to dividends? And really had a systematic, rational account. It's fluid and so on, but just they embrace this approach to thinking about their job, what they're doing as a corporate entity. So I think that would be an easy thing, as long as it can't be window dressing. You can't just have it wrong. And I'd flip it around and say, why are your S&P, the poor man's, that's a funny concept, the poor man's research on the S&P 500. And I remember talking to you about that, and you found very few that have such a thing. And I went and looked at the few that did, and they're in the higher density of shareholder.
Oh, absolutely. Yeah, that's right.
And I think, so what you saw instead is almost every company has the same three board committees: the audit committee, the comp committee, and the governance committee. And we could step back and say, why are those three? Well, most of it is because of systemic reasons, not firm-specific reasons, but general things. So audit committees, obviously the accounting function is extremely important, but it's really a Sarbanes-Oxley thing that every company has to have an audit committee. Right. The comp committee is in part because of Dodd-Frank, which put some policing around it, but in part because of executive compensation just got so explosive and kind of out of control. And then the governance committee, it's really a large function of the increasing power that index funds assumed over the past 30 or so years, and they've just put a lot of pressure on that function around formal aspects of board service, or board structure, like the number, the diversity, frequency of meetings, attendance at meetings, and so on. And all of that, all that may be important, finance, comp, and governance. But I agree with you. I think the most important job on the board, hiring and firing a CEO, but is assuring that there is thoughtfulness around strategy and capital allocation. And so it is sort of funny that we have these other big time-consuming committees and less conscious commitment to what is probably the most important function, and it's certainly the most important function for the quality shareholder group.
Yeah, and that's kind of the problem, which I think you would know this better than I would, and better than almost anyone certainly, is that when you're involved with a great company like Constellation Software, this is not necessary. I think when you raised this issue with Mark Leonard, his comment was why we don't need a committee. It's at the core and the essence of every single thing that we do. And he's right. So I'm not in favor of mandating this and creating more work and more bureaucracy, because inevitably you're going to have companies like Constellation and Berkshire that are already high performing, already doing all the right things. You don't want to force some unnecessary change down their throat. But it gets back to kind of this existential question of, for the companies that are in the 99% that don't already have that kind of culture in place, how do you go about changing that culture without making the structural reforms? Or maybe the answer is, that's why this is so hard, and you can't change the culture, and you're just kind of back to the drawing board, and without some sort of external forcing mechanism or just having some light bulb moment at the CEO or the board level, you're just kind of stuck. I mean, how do we solve that sort of chicken and egg problem?
Yeah, the companies have to want to do it, and our audience, my audience, and I think your audience is principally managers who have at least some willingness to understand the points we're trying to make. That the idea of attracting committed long-term shareholders who are become essentially business partners and who will help around thinking about what should be the highest priority inside the company. So that's the primary audience. Managers who are open-minded to thinking about this. There are other managers who for whom it would be, just to be frank, a waste of our time to try to explain this. It's just not something they're interested in. They want a high stock price and high net income or high earnings and good stock option results or other kinds of perks of having large company to run and all the glamour of the position. And so getting through to them is I'm not going to really spend my time trying to do it. But I think that there's a meaningful percentage of corporate America where the managers would be open to this conversation, and then would discover that they might benefit from it, and then begin to lead the internal charge towards prioritizing long-term stockholders, who really focus on the company, and who would appreciate that the company is now trying to think about capital allocation in a rational way, and has recruited a board of directors that understands this idea and are focused on it. And you're right, at Berkshire and Constellation, and there are 30 or 50 other companies that we could add to the list. It's already embedded in the culture, and maybe because it's Warren or Mark or the other CEOs, but it's usually a deep bench of people who appreciate that what we're doing is deploying equity capital, shareholders' capital, and the idea is to deploy that at high rates of return over very long periods. And so whether we reinvest in the existing product base, whether we make a tuck-in or a bolt-on or a move into a new area, or return the capital to the holders, in some ways, every decision at the company is a capital allocation decision. And you're right. That's what Mark quipped when I raised your idea with him, that we can't really have a capital allocation committee at Constellation, because that's basically everything we do. We have an audit committee too, but all the important strategic issues in front of the board are ultimately capital allocation issues.
Yeah, and like I said, I think that's a big part of why Constellation's been so successful, and there's no point in making them reinvent the wheel, which is why I don't favor necessarily a Sarbanes-Oxley style mandate for it, although that might have some good consequences despite some drawbacks to it. But I do think one thing that'll help in this direction is a book like this, frankly, because I can't wait to send this book to many CEOs and board members that I know, because I'm hopeful, maybe I'm naive in this, but I'm hopeful that there are enough CEOs and board members out there that feel this pull in this direction, but they just don't have either the institutional support or the quantifiable empiric evidence that they can rely on, or just they need something to get over the inertia to force this change. And, I think another good example of it might be Will Thorndike's great book, The Outsiders. I know countless investors and CEOs and board members have interacted over that book, and it's been a real touch point. And I think on balance, it's been a huge positive for corporate function and for corporate governance. And I really think this book can play the same role. What else do you think we can do as investors other than buying a lot of copies of this book and sending it around?
Thanks, Phil. And I concur about Will Thorndike's book. It's an outstanding book. He really poured his heart and soul into that for a long time, and it's wonderful that it's had such a positive effect. And he's now led a foundation to give an annual award to the best capital allocator. And so right. I think that's say it again.
Yeah, I said that's right. Yeah.
Yeah, Singleton, I think. And so it's, I think, worth stressing too is that I think his audience and my audience and maybe yours it's almost a self-selected group. I mean, again, the CEO's got to have an open mind and be willing to embrace what is in some ways an investor's point of view. And CEOs don't always come up that way. They come up through engineering or product or customer service or finance and so on. And so they don't always sort of think about the owner's point of view. And the ideas that Will was putting forth and the managers who embrace them are thinking about the business from the owner's point of view. And so they're thinking about how every dollar is allocated. And I think to your point about, not imposing it, not mandating, I agree with you entirely, because I think one of the things is that each company's menu. What will work for them is going to be a little different. And so I prefer an idea where companies, managers and companies who want to get the benefits of cultivating quality shareholders self-select and signal that this is something we are taking seriously and that we would like to do. And then they signal that to the marketplace, and this group responds, and you'll get the good returns. I mean, in other words, this will ultimately be performance driven. I mean, when we turned around and looked at the performance of the quality shareholder cohort as investors, and then the economic performance of the companies that tend to attract them, they, not in every case, but they tend to outperform. So having this approach is economically rational. And I think if we can educate enough CEOs and boards in this approach and this philosophy, and it's embraced by them, I think that would be the reward. And so I think just what Will did and what you and I are doing, I think is that's the action step. And I don't think we can expect to do more. I mean, our megaphones are limited. I mean, my estimate is that the quality shareholder cohort represents about 15% ownership of public equity. So the indexing world commands about 40, the transient group another 40, and activists at various times a total of around 5. So it's a relatively small group with less political clout and less visibility and so on, but it can be a decisive one. And so I think just trying to share that message, share that point of view is probably at least the practical view and goal that I'm setting.
One other thing I want to circle back on that you mentioned earlier that I hadn't thought about with regard to the lending side and bank groups and bond owners is the contractual element of it. And I hadn't thought about that, but that's really interesting. And I still want to think more about why that would have a lot more of a two-way relationship. I mean, I get it that you want to understand what's in the indenture or what's in the credit agreement, but maybe it would help. I mean, supposing you're right, and that it does make a lot of sense to me. Supposing you're right, I mean, one way to increase the relationship on the equity side and encourage quality shareholding would be to increase the structural, almost contractual element of it. Now, obviously, you're not going to have a contractual agreement to buy and sell stock like you do to, come in and out of a bank group or something like that. But one thing that I've also been a big fan of and a big proponent of is the concept of an owner's manual. Obviously, again, that came out of Berkshire Hathaway, and they have an explicit one. There's a handful of other companies that have one. Morningstar's is excellent. Google and Alphabet have a version of it. Constellation certainly adheres to that philosophy and has its own version of an owner's manual. But here again, it's just a great opportunity where every owner's manual, by definition, would have to be different and completely tailored to that specific company. But just the process of creating one is enormously helpful. And having done this and helped Alaska go through it, I mean, to their enormous credit, they put in a huge amount of work and really made enormous progress. And we're on the cusp of rolling this out right when the pandemic hit. And it's just ironic and enormously sad that their attention had to go elsewhere for now. But the process of doing that was both enormously helpful for them, and unfortunately now we have to wait and see, but I think would have been enormously helpful in cultivating their shareholder base and steering it away from people that were using airlines as a macro hedge or an oil hedge or just a trading sardine where they're jumping in and out of things, and really encouraging a longer term view of the company. So, there again, I don't know that it's something that should ever be mandated. I'd be very hesitant to see it be a check the box requirement for large shareholders to say, we're not going to own your stock unless you publish an owner's manual, something like that. That would come with a lot of unintended consequences as well. But just wonder what your thoughts are on the concept of an owner's manual and how we could maybe push that forward as well.
I think it's an excellent idea, and and I agree with you too that each company's owner's manual would need to be different. But I can also suspect that many should have the kinds of, at least some of the tenets in the Berkshire one. Start with something that does indeed feel contractual in Berkshire. So I think it's the first one that says we feel like we're partners. Right. This is not a traditional corporate hierarchy where we're helping ourselves to corporate resources that you don't share in. It's a flat partnership, and if I gain $1, so do you. It's funny when he said that. Warren wrote in the owner's manual that Berkshire's attitude is partnership. Some of my law friends thought, it doesn't take much to form a partnership, and him having said that might mean it is a partnership, and that imposes certain significant legal duties on Warren. So, and that expresses what we were just talking about around how I think the idea of focusing on capital allocation is very much an owner-oriented idea. And so tenet number 1 in the owner's manual might indicate what's our view of the legal relationship, or the relational aspect of this operation. Is it corporate and hierarchical? Is it more like a partnership? Another one that jumps out at me is, I think it's his second one, that the directors and the managers have a significant portion of their net worth in Berkshire stock. I think that's an extremely important element of the owner's manual. It's an alignment point, obviously. And it's not just what percentage of the company they own, but what portion of their net worth is at stake. Something that is almost never stressed in corporate America, but it's probably the most important thing. It's a sense of being a quality director. That is, you have a concentrated portion of your net worth in it. And so I do think that an owner's manual is a good idea, and I think it ought to be tailored to the particular business. But we'd have some features I think we'd see in common. In fact, Phil, one way to read in effect, the table of contents to my book and this research that you've been doing is that here are 20 levers or practices or policies that corporations have used that are associated with attracting high quality shareholders. And so study these 20 features and then evaluate which of these do seem to make sense for your company, whether it's a partnership attitude, high director investment, or something else. No stock splits, no quarterly calls, rational capital allocation, a capital allocation committee, whatever it might be. And then make that case, make that statement, as Morningstar has done. I'd support that kind of thing. And I'd stress too, it doesn't. Warren took it to the formal extreme in that he wrote it all down, explained it, updates it, puts it on the website. It's a very textual, formal statement. Constellation doesn't have that formal statement, but there's just no question about its emphasis on the long term, on product innovation, on capital allocation, on developing its people. Why is there no question? Well, part of it is because Mark explained that. Mark Leonard, the CEO, explained that in annual letters that were very thick, thoughtful, and engaging. He makes those. The whole team makes those points at the annual meetings. The company fields questions that are submitted by shareholders throughout the year, and so it's never been written down. And I think the culture at Constellation is a much more non-textual. That there's a lot of shared practices, shared knowledge. We talk about there being a playbook and stuff, but it's not written down anywhere. It's not codified anywhere. It's an oral history, if you like. And so there are different ways to adopt this approach, adopt this owner's manual. And I think Warren did it in a very formal way. Mark has done it in a much more informal way. And I think, again, in the spirit of self-selection or flexibility, I'd leave it to if the company and its current sort of leadership and outlook about whether they'd prefer to have it all written out in a very formal way, or rather more expressed periodically and as a more of a living kind of tradition.
Right. And that's a great point. And on the self-selection issue, or maybe put differently, that we're all kind of preaching to the choir here, I've always been somewhat skeptical that you can really change the culture, particularly once it's ingrained for good or for worse. It generally is coming from the top. It's very difficult to change. I think we've all seen that both anecdotally and in the data, that it's very difficult to achieve that. So it gets to this issue of what's realistic here. And one of the questions I got when I solicited some questions in advance for this was, is this concept of a quality shareholder really just code or another way of saying that a quality business, or put differently, even a quality management team, is just attracting the shareholders it deserves, i.e. that there's nothing that can be done or changed here, and this is all just sort of a self-fulfilling prophecy because Warren Buffett and Mark Leonard are great business leaders, and therefore they were going to get what they deserve, and all the rest of this stuff is just kind of pomp and circumstance. So wonder what your response to that would be.
Yeah, I mean, I think that you're right. Culture is sticky. It's all about behavior and the norms that are percolating in a system, and that could be a company, a school, or society, or what have you. And so it's extremely hard to change. It's defined by the leadership in both Berkshire's and Constellation's case, effectively by the founder, who then leads a team that ultimately has a bit of almost a Darwinian self-selection, where people who aren't on that same cultural page leave. So that's all true. On the specific question about how to describe this, identifying quality shareholders and thinking about quality businesses, it's a more rigorous first cut. At least the first step in this is empirically to identify those funds, those investors that have the longest average holding period. And in our research, we try to identify that using lots of different little tests. I explain them all in an appendix to the book, but long average holding periods and then high concentration. So the opposite of the indexer. And so we empirically and kind of rigorously, statistically identify who are these holders. And then using the same approach, we figure out which companies attract such holders in high density. And so, and then, it might be the case that the questioner is right by saying, well, it's not surprising these companies get the shareholders they deserve. So the companies that do certain things attract high quality shareholders, and they get them. Companies who don't, are stuck with the transients and the indexers. So it might be that when we do the empirical research, we're discovering what you might have thought you already knew. But nevertheless, when you look down the list, so I've got 2,070 companies that I list out on a high to low density of quality shareholders, and a bunch of them, especially the ones toward the bottom, they don't care about what we're talking about. And so the questioner is right. But those in the middle and at the top, they'll say, yeah, I'd really like to have, more shareholders that are sticking around a long time who load up on our stock, and I can talk to and count on. And so, and they can be educated and helped to do this. So I don't think it's, I think the reader's right. The questioner is right that, managers get the shareholders they deserve. And that was a subtitle of the book at one point, I think. But the idea is that there may be managers right now who'd love to have more quality shareholders, but it's a minority group. They're 15% of the population in aggregate. In terms of ownership. I mean, they're just maybe just a few hundred of the real sizable groups that you can attract. So I think that I'll bet there are some managers who deserve a higher density of quality shareholders and just haven't thought about it or haven't inventoried the mechanisms. And so that's, I think, the purpose of this research and of your work is to say these managers, you can improve the quality of your shareholder base. I mean, I don't think you're not going to fool anybody. You're still going to get the ones you deserve. So I don't think mediocre managers or managers who put their own pockets ahead of the holders are going to get a high density of quality shareholders. But I'll bet they're conscientious, owner-oriented managers who for various reasons aren't getting enough of the ones they deserve, and that they could improve their base by at least thinking about some of the strategies that you and I are talking about.
Yeah, that's a great point, and it's one thing that also kind of hit me over the head in this process, along with the explicit cultivation of a lending group and the explicit, or the lack of doing so for the equity side, was that, and there's no way to quantify this, but my strong argument would be that over the last 10, 20, and 30 years that corporate managers, corporate executives have upped their game. I think the average, however you want to define the average or median, let's say S&P 500 or Fortune 500 company today, is better managed than it was a few decades ago. And that manifests itself in all sorts of different ways. But then you look a little bit into little pockets, and one area that still just seems stuck in the dark ages is this concept, the governance, investor relations, capital allocation, three-legged stool that we've been talking about. And that's just what's so mind-boggling to me is we have, our world-leading companies right now still splitting their stock to increase the transient percentage of their shareholders when there's already plenty of them to begin with, just sort of boggles the mind. And so as I've watched with fascination as the ESG movement has really gained steam in the past few years, and largely for good reason, just like the passive indexation revolution has gained steam for many years for mostly good reason, it seems to me that of the E, S, and G, the one area that could make the most difference would be the G. That seems to be getting the least attention right now. But I wonder what your thoughts are, and then I'll turn it back to John, is just if you had to take glass half full, glass half empty, do you think corporate governance writ large is getting better right now, getting worse, or are we still just kind of stuck in the mud and going nowhere?
I think overall there's been an excessive tendency to impose one-size-fits-all ordering, whether it's to separate the chair and CEO function, whether to have a certain size of board or those certain committees that we talked about, certain tenure limits or numbers of board limits. You look down the Institutional Shareholder Services annual manual that they come out with, they're just 40 or 50 just rules that every company has to have, or they get a bad grade or withhold votes on directors. And it just, so I think we've gotten too systematic and not firm specific enough. And I do think that's a problem. And I think it's a place. I mean, one of the reasons for that is because of index investing. It's impossible for BlackRock, Vanguard, State Street, or even smaller indexers to follow every company that they invest in, or to make a judgment that, well, here the chair and the CEO ought to be different, or here these directors ought to be able to stay on beyond, say, 10 years, or here it's okay to have 3 insiders or something. So that's my chief critique of the prevailing system. And I think the other point that you make, I think is a very, very important point around the indexers, is that the ESG is, it is too focused, if you like, on environmental and social matters, important as those may be. They tend to be easier to generalize, that we ought to have, look at this, your carbon footprint or your CO2 emissions, and then and here's where you need to be, or the social aspects around diversity or promotion or so on. And they've been overemphasized. And so I'd like to see even those indexers, to the extent they're able to do that, to focus a little bit more on governance variation. They claim to be doing it. All the big three have said, well, we're hiring more people to go out and interact with individual companies and to try to make individualized judgments. But still, the staffing is just slight compared to the number of investees that they have.
Yeah, right. I agree. And I think to that point, if you get the governance right and you really cultivate this culture of long-term ownership, it will eliminate a lot of the problems you have on the social or even the environmental front. So I think it just is kind of a panacea to the extent such a thing exists. So anyway, I just can't compliment you enough for your work on this topic. It's fascinating to me. I think it's the way of the future. And I know the book's not out yet, but the paper certainly is. And I think both will be a huge resource for years to come. So thank you for all your time and work on that, and for sharing your thoughts with us here. It's greatly appreciated.
Phil, if I could just say one more thing. I mean, your point about the improvement of managerial sophistication or professionalism over the last 30 or 40 years, I think you're absolutely right about that. And it might be that this topic is the last one that needs improvement. And I think it's partly because the data haven't been there. I mean, I think people have an intuition that a high quality shareholder base may help a company. That it's just some intuition that if the stockholders matter, but it's never been quantified. It's never been systematically investigated. And I think what you have begun to do, and what I'm trying to do, is uncover, turn that stone and try to say, yes, we can measure this, and the intuition is supported by the data, and so I think that's going to be an important contribution to this work too.
Agreed.
Great. Well, thank you so much, Larry and Phil, for this fascinating conversation. It's a incredibly important topic. And again, for those of you who may not be aware, Larry and I spoke about his book recently, and I'd encourage you to go find that conversation as well. We will be back next week with Phil, Elliot, and Chris. Until then, goodbye, everyone.
Thanks, guys.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.